Hi everyone and welcome to Blockchain Whispers High School of Crypto. We hope you enjoyed our previous video where we covered the basics of charting, where you learned the very basics. In today's lesson about chart patterns, we will dive deeper into the world of technical analysis. When the BCW Premium Group gets a call, these patterns are already identified before the signal is given. Remember guys, to grow your portfolio it is essential to buy low and sell high. We want you to strive for success, increase your portfolios. Frankly, we want you to become rich and achieve all your dreams and goals. Blockchain Whispers is known to be one of the most accurate crypto predictions team in the world. This is our treat for the crypto community, all for free to learn and gain knowledge about crypto and trading. In this video, we will cover the subject chart patterns, where we will be explaining the following topics: reversal patterns, continuation patterns, bilateral patterns, and Blockchain Whispers approach. When looking at a chart, some of us see circles of waves without any sign of whether the price is going up, down, or sideways. Today we will be covering some of the most popular chart patterns, which will help you determine whether the price is going up or down. First of all, chart patterns are historic studies that certain patterns appear consistently and tend to produce the same outcome repeatedly. For example, if there is FUD in the market, a pattern may be forming before the price actually forms, and this could help you exit the market in a timely manner without incurring unnecessary losses. A popular question we have been receiving is, what time frame should I spot these patterns? The answer to this question is, it depends how long you're willing to hold the coin in question. If you're looking to make a quick trade like a hit and run, then you should seek 5 minutes to 30 minutes time frame and expect up to 10% gains. If you're willing to hold the coin for a couple of days up to a couple of weeks, then you should select the 1 hour time frame up to 4 hours even for 10% or 20% gains. And finally, if it's a long term which requires you to hold for over a month, then you should use the 4 hour up to 1 day time frame. It is important to note that chart patterns are just an indication of where the price may go in the future, and they are not foolproof. If this was so, then you could easily become the best trader out there by simply spotting chart patterns. However, do not be disheartened, because we will show you how to trade these chart patterns and how to minimize the risks. Reversal patterns occurs when the price is going in one direction and a pattern forms to signal that the trend is about to change direction, hence the name reversal. In simpler terms, if a reversal pattern forms during a downtrend, trend will reverse and the price goes up. On the contrary, if the reversal pattern forms during an uptrend, trend will reverse and price goes down. Popular reversal patterns include double top, double bottom, head and shoulders, inverse head and shoulders, rising wedge and falling wedge. A double top pattern forms when the bulls attempt to push the price above resistance point. This scenario occurs twice, however in both cases the attempts fail to break. This results in bulls giving up and retracting their orders while bears take control over the market price. The double top pattern looks like a letter M. Note that the triple top could form, which is a stronger pattern than a double top. However, this does not occur as frequently as the double top. The triple top has the same attributes as the double top and confirms the price will reverse and commence a downtrend. Here is an example of a double top pattern. Initially, price rises and bounces off resistance. Price rests on the neckline, which is temporary support. A second attempt to break resistance fails and price drops below the neckline or temporary support. This is confirmation that the bears are in control and the price breaks down. When trading these patterns, caution must be taken by timing entry, exit, and also have a stop loss in place in case things do not go as planned. Double top is sought by bears and entry should be just below the neckline or temporary support. A stop loss should be placed above the neckline to avoid whipsaw or false breakdown. Your target should be further down, preferably just above the next support line. Here's a tip for you guys. A double top usually occurs at the top of the uptrend. The first attempt in breaking resistance usually has substantial volume. The second attempt, however, occurs with relatively low volume as bulls lose confidence. A double bottom pattern occurs when the price drops and bounces off support. Then it retests support and bounces off once again. This shows us that support is strong enough to hold and reverse to commence an uptrend. The double bottom looks like the letter W, and the twice touched low is the major support area. Note that the triple bottom could form, which works the same as a double bottom and suggests a bullish reversal is about to occur. Here you can see an example of a double bottom. The price holds at temporary support where the first test occurs. A second attempt occurs, and if support holds, then it becomes a major support area, which suggests a bullish reversal and the beginning of an uptrend. The second bounce also suggests that bulls are in control, since the sell pressure found rock-solid support in the same area twice. Double bottom is a trade that the bulls search for. Entry is timed above the neckline with a stop loss below the neckline, just in case the breakout from the neckline is fake. Target is further up from the neckline, preferably before the next resistance area. Here's a tip for you. Volume on the second test should be evident for successful reversal and breakout. Head and shoulder pattern takes time to form, and it is made up from different components. It is comprised of 3 peaks, 1 head and 2 shoulders of equal length, more or less. A head and shoulder forms after a long bullish trend. Price rises to a peak and drops to form a trough which stands on the neckline. This is the left shoulder. Price then rises again to form a higher peak and drops again to the neckline. This is the head, since it rises further than the previous peak. Price rises once again and forms a peak around the level of the first peak. From here on, price drops below the neckline to form a bearish trend. Here you can see a head and shoulder pattern taking place on a chart. Let's have a quick run through. Price rises above the neckline, makes a peak and drops to the neckline. That's the left shoulder. Price rises from the neckline to form a higher peak and then drops again to the neckline. This is the head. Price rises one last time and forms a peak as high as the left shoulder and then drops to the neckline or below. A head and shoulder pattern is sought by pairs. The best trading strategy here is to seek entry below the neckline and a stop loss above the neckline. Sell target should be set further down the neckline. An inverse head and shoulder is the complete opposite to a head and shoulder pattern. The inverse head and shoulder pattern is a bullish reversal pattern which signals the end of the downtrend. The price falls downwards and forms a bottom and then pullbacks. This is the left shoulder. Price then drops to form a lower low and pull back to the same area of resistance. This is the head. Price falls again one last time and pullbacks, breaking the resistance on the way up. This is the right shoulder and the beginning of reversal. On this chart you will see an inverse head and shoulder pattern. The price is in downtrend and forms a bottom below the neckline and then pulls back to the neckline. Price falls again and forms a lower bottom and pulls back to the neckline. Price falls again and forms a bottom more or less close to the left shoulder's bottom and then attempts to break the neckline to complete the reversal. A head and shoulder pattern is sought by bulls. The best trading strategy here is to seek entry above the neckline and a stop loss below the neckline. Sell target should be set further up the neckline. The rising wedge is a pattern where the resistance trend line and the support trend line are both rising, but they are converging, with the support trend line rising faster than the resistance trend line. This suggests a bearish pattern. Volume may also be an indication where it tends to fall when forming this pattern. As explained in the previous video, to draw a trend line you must connect 2 peaks or 2 throughs. In this chart, the upper trend line must increase at a lower rate than the lower trend line to confirm it. The price bounces off these two trend lines repeatedly until they are close to convergence. This pattern is recognized as a reversal if the price was increasing before the pattern is formed. Rising wedge is a bearish pattern where the best entry is slightly lower than the bottom trend line, where the temporary support would be clearly breached. The stop loss may be placed a bit higher than the resistance trend line. Target is further down the price chart. The falling wedge is the exact opposite of the rising wedge, where the upper trend line and the lower trend line converge, with the upper trend line falling at a faster rate than the lower trend line. This is a bullish pattern, but this time it must surely be supported by volume, as a breakout becomes a fakeout without increasing volume. The falling wedge can be identified by finding two trend lines that are contracting, but both are falling. The upper resistance line is falling at a faster rate. The price tends to bounce between these two lines until the time graph approaches close to the point of convergence. It is identified as a reversal pattern if before entering this channel the price was at a downtrend motion. The best course of action here is to trade a bit higher than the upper trend line to ensure you trade the breakout. A stop loss may be placed a bit lower than the lower support line, just in case it turns out to be a fakeout. The target is further higher than the resistance line. Here's a tip for you guys. Upon trading this bullish pattern, monitor the volume and ensure that it is increasing during the breakout. This will confirm the breakout and you can trade this pattern safely. Without increasing volume, it will be vulnerable to failure. Continuation patterns, also known as consolidation patterns, occurs when the price is going into one direction and pattern forms to signal that the trend will resume in the same direction. In simpler terms, if the continuation pattern forms during a downtrend, the trend will resume and keep heading down. On the contrary, if the continuation pattern forms during an uptrend, trend will continue and price keeps going up. Continuation patterns include bullish rectangle, bearish rectangle, bullish pennant, bearish pennant, falling wedge, and rising wedge. The bullish rectangle is formed by two parallel trend lines where the chart forms a trading range. This is a very simple chart to identify, and it would be clear that the channel is forming. This pattern shows a period of consolidation between the buyers and the sellers. The price generally bounces off the support and resistance lines several times. This pattern is identified by obtaining two trend lines that are parallel to each other, in which the price bounces off the lines without a breakout. The rectangle is bullish if the price is at uptrend motion, meaning that before entering this channel the price was rising. The point of entry for this pattern should be slightly higher than the resistance line to ensure that you are trading the breakout. The stop loss should be placed below the support line. The target should be further higher than the upper trend line, usually about the height of the rectangle formed. The bearish rectangle is a continuation pattern that acts like a pause during a strong decline in price. This is once again a period of indecision between buyers and sellers. Like the bullish rectangle, this pattern is formed by two parallel trend lines where the price tests the support and resistance levels several times. Two parallel trend lines are drawn to identify a rectangle pattern. The price bounces off the support and resistance, but never breaks them. The rectangle is recognized as bearish due to the movement prior to entering this channel, where it could be a downtrend. This bearish pattern is best traded by entering at a slightly lower price than the support line. This will ensure that the breakout is traded. A stop loss may be placed higher than the resistance trend line, just in case the pattern continues without a breakout. Target is further lower than the support line, usually about the height of the rectangle. The bullish pennant is a continuation pattern which is usually short-term. This is a pattern that is formed by a sharp increase in price, followed by a small consolidation of price. This sideways price movement is then generally followed by another increase in price. This is similar to the bullish rectangle, where an uptrend is paused by a short period of indecision. This pattern is identified by finding a sharp increase in price followed by two trend lines that start apart from each other and contract to a point. The price stays between these two trend lines and its movements gets very limited as time passes. This contraction is very quick and usually followed by a continuation in the previous uptrend. This bullish pattern's point of entry should be at a slightly higher price than the end of the resistance trend line, close to the point of convergence. A stop loss can be placed at a price lower than the lower trend line. The target price is higher than the resistance line, generally about the same height of the previous sharp increase formed. The bearish pennant is similar to the bullish pennant, but instead of a pause in the uptrend, it is a small pause in the downtrend. The bearish pennant is a small consolidation in price, where the price bounces off the trend lines that contract into each other. This pattern is preceded by a large dip in the price and is usually followed by further drop in price. To recognize a bearish pennant, one must find a large drop in price, followed by a price staying in between the two trend lines. Upon approaching the point of convergence, the price is expected to fail. The best strategy to trade a bearish pennant pattern is to wait until the price is close to the point of convergence. Then place the order at a slightly lower price than the lower trend line. You can place a stop loss at a slightly higher price than the upper trend line. The expected target should be about the same price decrease of the sharp drop prior to the bearish pennant pattern. The falling wedge continuation pattern is slightly different than the reversal one, where instead of prior to the channel there was a downtrend, now there was an uptrend. This is a convergence pattern where upon approaching the point of convergence, the price increases once again and continues its uptrend. This falling wedge may be seen as a small pause in the uptrend motion of the price. The falling wedge is identified by two trend lines falling, but the upper trend line is falling at a faster rate than the lower trend line. The price keeps bouncing off these two trend lines until it gets close to the point of convergence. At this point, the price is expected to break out. The best point of entry for a falling wedge pattern is slightly above the upper trend line when close to the point of convergence. A stop loss may be placed below the lower trend line. The price is then expected to break out, and the target should be at about an increase of the same price difference between the upper and lower trend lines at the beginning of the falling wedge. The rising wedge forms during a downtrend where there is a small consolidation in the price. The price rises for a small period of time until it approaches the point of convergence, at which point it will break out and continue its downtrend. To recognize a rising wedge continuation pattern, one must draw two rising trend lines where the bottom trend line is rising at a higher rate. This is preceded by a downtrend motion in price, and upon approaching the point of convergence, the price falls once again. To trade a rising wedge pattern after being identified, one must place an order slightly lower than the bottom trend line. This way, you are trading the breakout and the price is expected to fall at that period of time. A stop loss may be placed at the price higher than the upper trend line. The target is a drop is about the same height as the beginning of the rising wedge pattern. Bilateral patterns occur when the pattern formed could lead to the price to go either direction, meaning either up or down. These are a bit tricky and require caution with a tight stop loss. If you wish to trade these patterns, popular bilateral patterns include ascending triangle, descending triangle, and symmetrical triangle. An ascending triangle can be a bullish or a bearish pattern, where a triangle may be seen by a horizontal upper trend line and a rising lower trend line. This pattern suggests that the price has tested a resistance for a period of time but never managed to break it. The support is always increasing, and as a result, a point of convergence can be seen. To recognize an ascending triangle, one must draw a horizontal line where the price has tested several times the resistance and bounces back down to a higher through than before. It must not be confused with the pennant pattern, where a trend line is falling while the other is rising. What follows this pattern is unpredictable, so one must look at the general trend of the price. To trade this pattern, one must enter at a point close to the point of convergence of the trend lines at a slightly higher price than the horizontal trend line. A stop loss should be placed at a slightly lower price than the ascending trend line. The target price is calculated to be the distance between the trend lines at the beginning of this pattern and added to the horizontal trend line. On the contrary, if you decide to short instead, which means you're betting for the market to go down, your point of entry is slightly lower than the ascending trend line, and the stop loss is placed at a higher price than the resistance line. The target is the maximum distance of the pattern below the breakout price. The descending triangle pattern is similar to the ascending triangle one, but rather than a horizontal resistance line, there is a horizontal support line. The other trend line is the upper descending one, formed by lower peaks. The descending triangle can be identified by forming a right-angled triangle with a falling trend line and a horizontal support line in which the price tests that support area several times. Upon approaching the point of convergence, the price is expected to break out in either direction. To trade the descending triangle pattern, one must first decide whether to short or long the price, meaning you're betting for the market to go up or down. The breakout direction is unpredictable, although one might look at the general trend of the price to get an idea. If you decide to long, you must place an order at a slightly higher price than the descending trend line. The stop loss must be placed at a slightly lower price than the horizontal support. The target price is calculated by adding the widest distance of the pattern to the breakout price. On the other hand, if you decide to short the price, you must place an order at the lower price than the horizontal support line, while the stop loss should be placed at a higher price than the descending trend line. The target price is calculated by decreasing the breakout price by the widest distance of the descending triangle pattern. This pattern shows a period of consolidation in which there are lower peaks and higher throughs forming. This pattern is very similar to the pennant one, but this can be identified as the rate of the decrease of the upper trend line is equal to the rate of the increase of the lower trend line. Again, this pattern could lead to a bullish or a bearish trend. To recognize this pattern, one must draw two opposing trend lines which are converging and are symmetrical around the middle. This is caused by a period of indecision by the buyers and sellers where the price bounces off the upper and lower trend lines. The breakout direction can only be determined after the breakout occurs. To trade this pattern, one must wait until the breakout occurs. Upon breaking the pattern, one must place the order at that price. A stop-loss order may be placed at a slightly higher price of the upper trend line if the breakout is a bearish trend, or at a lower price than the bottom trend line if the breakout is bullish. The expected target can be estimated by either adding or deducting the minimum width of the pattern to the breakout price, or by drawing a new trend line parallel to the trend line in which the breakout direction is heading. So in today's high school lesson about chart patterns, you have learned the following things: how to recognize and trade reversal patterns, continuation patterns, and bilateral patterns. Practice on recognizing chart patterns before continuing on our next lesson in High School of Crypto, where we will be learning about trading tools. You will see that in our next chapter after the high school videos, where we will continue the journey into College of Crypto, you will learn about different methods to trade such as Elliott waves and Fibonacci retracements. To give you an example of the call we've given in the past based on chart patterns, I will explain the following call with the chart for you. On the left of the image, you can see a chart displayed. The chart has a falling wedge pattern. It's a bullish reversal pattern as explained on this lesson. We made the call based on the falling wedge pattern and shared the call with our members on the convergence area to buy on the 18th of August with no sell targets. On the right on the image, you will see that on the 23rd of September, premiums received a call to sell, making them all great gains. Join our premium service on www.blockchainwhispers.com, register on our website, verify your Telegram in My Profile, click Become a Premium and choose your package. And then after successfully becoming a member, you will have access to our premium signals and premium chat. Thank you for watching today's high school video of Blockchain Whispers School of Crypto, where we covered chart patterns. Stay tuned for our next lesson where we will be focusing on Trading Tools 1. In the lesson Trading Tools, we'll explain more of the following indicators and how to read and use them: MA and EMA, RSI, Stochastic RSI, and MACD. These are important indicators used by every technical analyst. Make sure to practice on recognizing chart patterns, because after high school there will be a quiz again to access the College of Crypto in your journey to becoming rich. Subscribe to Blockchain Whispers on our website www.blockchainwhispers.com. Read all the posts from the very beginning and you will learn about our journey, why we are the best, and how Blockchain Whispers could help you get financial freedom by becoming a pro trader. This is Blockchain Whispers, baby.